There is a massive misconception floating around the market today. It says that Indian IT service companies are going to be wiped out by generative artificial intelligence. The fear is that automated coding bots will replace software engineers and our digital economy will completely collapse. And because of this fear, many investors think the only way to make money in the AI boom is by buying shares of the massive American tech monopolies. But the data from the ground shows a completely different story. Today we are going to look at what is actually happening with AI investments in India. We have moved past the initial hype phase. We are now entering what industry experts call AI Layer 4. This is the integration phase. During the first few years, the market obsessed over who was building the smartest foundational models. We saw ChatGPT from OpenAI, Gemini from Google, Claude from Anthropic, and Grok from xAI. These companies spent billions training massive systems. But having a smart model is like having a powerful engine without a car. Enterprises need someone to build the car, secure it, and put it on the road. This is exactly where Indian companies are stepping in. Indian IT integrators are not being wiped out, they are climbing up the value chain. They are shifting from effort-based pricing to value-based pricing. Global enterprises are hiring Indian firms to orchestrate complex architectures and deploy AI securely into highly regulated legacy systems. This Layer 4 integration is a unique equity play for Indian markets. You do not always need to buy US mega-cap stocks to profit from this technology. The companies successfully monetizing AI deployment are often the specialized software service providers solving real business problems. But what about the models themselves? Bigger is rarely better. Another common myth is that bigger AI models are always better. The reality is quite the opposite, especially in sectors like financial services. Small language models are rapidly taking over the Indian banking sector. Why? Because they cost significantly less to run, they reduce response latency, and they ensure strict data privacy compliance under the Digital Personal Data Protection Act. Indian banks cannot send sensitive customer financial data to an open-source AI or a global public server. They need closed, highly secure, and very efficient systems. This makes domestic business-to-business AI startups prime acquisition targets right now. To support these local startups, the government has launched the India AI Mission with a massive budget of 10,300 crore rupees. A major part of this mission involves offering subsidized graphics processing units to developers. These subsidies lower the barrier to entry, letting investors back local AI startups that now have the computing power to scale globally. Alongside the hardware, the government is also tackling the training data problem. The AI Kosh platform is democratizing access to localized, high-quality datasets. This allows developers to train models on diverse Indian languages and contexts, creating highly tailored domestic solutions. We are already seeing the success of these domestic initiatives. Look at the sovereign cloud adoption happening today. Bhashini, the national language translation platform, is actively using Yotta and their indigenous Shakti cloud. This transition proves our readiness for population-scale sovereign AI infrastructure. When a government project of that magnitude moves to an Indian cloud provider, it sends a strong signal to the market. Furthermore, niche sovereign models like BharatGPT are finding incredible success in specialized regional workflows. These targeted models offer a strong warning to investors against making broad, blind bets solely on global hyperscalers and tech giants. The economics of artificial intelligence are also shifting dramatically this year. In 2026, the bulk of costs has shifted from training the models to actually running them, known as inference costs. As these daily operational costs rise, backing local on-premise hardware providers is yielding high returns for savvy investors. But with new technology comes new regulation, and the landscape is tightening. The new 2026 information technology rules force platforms to execute deepfake takedowns within 3 hours. This strict regulatory deadline is actively shifting investment risks towards companies with highly compliant security architectures and frameworks. So how does an everyday Indian investor actually gain exposure to this massive shift? One popular domestic route is through artificial intelligence mutual funds. These funds provide incredibly easy exposure to global and local tech trends without requiring you to pick individual stocks. However, the current price-to-earnings ratios in this sector are extremely high. The immense market enthusiasm has pushed valuations up, which demands very careful vetting of the underlying fund portfolio. You must look under the hood. Are they holding true AI infrastructure companies or just consumer tech brands exploiting the word AI in marketing materials today? If you want direct exposure to the international companies building the chips and the core infrastructure, you can use the liberalized remittance scheme. Many Indians are using the LRS route to buy US exchange-traded funds such as the semiconductor ETF known as SMH. This strategy provides direct exposure to the foundational layer of global AI hardware while also offering currency protection against the depreciation of the rupee. It is a dual benefit strategy that balances your domestic portfolio. But remember, the real magic happens when you combine global infrastructure with the localized deployment happening in our own vibrant country. Now here is where it gets interesting and what this means for you practically. Historically, what tends to happen in technology revolutions is that the companies selling the underlying tools make the most reliable profits. In the gold rush, it was the people selling pickaxes. Today, those pickaxes are the graphic processing units, the sovereign cloud data centers, and the integration software. The insight here is that you do not need to predict which specific open-source AI model will absolutely win the global race. You just need to position your capital in the companies that provide the essential services. Another thing worth knowing is that regulatory compliance is no longer just a legal issue, it's a financial moat. Companies that can easily adhere to the strict 3-hour deepfake takedown rules or seamlessly process data within the boundaries of the DPDP Act are going to win the major enterprise contracts. When you are looking at where to allocate your money, look for businesses that highlight data security and privacy as their primary product features, not just as an afterthought. It is these secure, compliant integrators that are quietly building long-term wealth while the rest only speculate wildly. The artificial intelligence landscape will continue to evolve rapidly. From 10,000 crore government subsidies to the rise of small language models in banking, the opportunities for Indian investors are vast provided you look past the headlines and follow the actual data. Stay analytical, avoid the hype, and focus on the infrastructure and integration layers where real value is being created daily. Everything we have covered today is purely for learning. Your financial decisions should be based on your own research and, if needed, guidance from a qualified advisor. Please subscribe, share this with someone who needs it. Thank you.